The World Cup is usually just about the scoreboard, but for your wallet, a new type of betting platform might be changing the rules. For years, if you bet on sports through traditional apps or bookies, the IRS treats every win as ordinary income taxed at your highest marginal rate, up to 37%, with no way to offset losses against other investments. However, emerging prediction markets are starting to argue for a different classification capital gains, which could slash those tax bills significantly and turn recreational betting into an activity with superior financial efficiency. When the government classifies how you place a wager, it determines whether that money is treated like a casino win or like a stock trade. This distinction matters because traditional sportsbooks fall under Section 165 of the Internal Revenue Code, where winnings are ordinary income and losses can only be deducted up to the amount of your wins if you itemize deductions, which most Americans do not. In contrast, prediction markets function as contracts for future events, similar to financial derivatives like options or futures traded on regulated exchanges. If a platform structures these correctly under emerging regulatory interpretations, profits realized from closing these contracts may qualify for capital gains tax rates rather than ordinary income rates. Let us look at the math, because this is where the difference becomes real money in your pocket. Imagine you place $500 on a World Cup game and end up with $1,000 in profit. Under the traditional sportsbook model, that entire $1,000 gain is added to your taxable income, potentially pushing you into higher brackets, or simply being taxed at 37% plus state taxes, which could be another 6% depending on where you live. You might hand over nearly half of those winnings before filing season even begins. And if you lost money on other bets during the tournament, that loss offers no benefit unless you itemize deductions, a path taken by less than 10% of taxpayers. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Now consider the prediction market scenario, where the activity is classified as an investment asset class rather than gambling. That same $1,000 profit could be taxed at 20% or even lower if it qualifies for long-term capital gains treatment, depending on how long you held the contract. More importantly, losses in this bucket can often offset other investment gains across your portfolio, not just gambling winnings, which means a bad bet does not permanently erase value from your financial picture, but simply reduces your overall tax liability like any loss in stocks or bonds would. The shift is about turning a recreational expense into an activity with the same tax treatment as buying and selling stocks, potentially saving you hundreds of dollars per tournament cycle, depending on your income bracket, just as corporate firms shifted leverage strategies in response to state tax hikes back in 1991 when North Carolina raised its top rate by 1 percentage point. Economic studies show that when a specific classification carries a lower tax burden, actors naturally shift behavior toward the more efficient vehicle, and this is exactly what we are seeing now with individuals moving funds from traditional sportsbooks to regulated prediction platforms that offer better after-tax returns. It is crucial to understand that this does not mean every platform offering futures on sporting events will automatically qualify for these rates without specific regulatory compliance. The IRS has historically taxed profits from futures and certain derivative instruments at capital gains rates, but only when those instruments meet strict definitions of financial assets rather than wagers based purely on chance. This means you must ensure the prediction market operates with a clearinghouse and adheres to federal regulations, similar to how exchanges like NASDAQ or CME Group operate for stocks and commodities. If the platform is unregulated, it may not receive this favorable treatment regardless of its marketing claims regarding tax efficiency. The fear that this represents a loophole for reckless gambling misses the point entirely, because the mechanism relies on the structure of the contract itself being an investment rather than a simple wager on chance. When you buy a share of Apple or sell a put option, you are engaging in financial risk management, not pure luck. In prediction markets aim to replicate that same framework, where prices reflect aggregated information about future events rather than just random outcomes. This distinction allows the government to tax these activities at lower rates because they serve an economic function similar to hedging instruments used by businesses to manage their own risks against market volatility or event uncertainty. As we look toward the next major sporting event, this classification shift could see hundreds of millions of dollars moving from traditional betting apps to regulated prediction markets driven purely by the tax advantage alone, without any change in how people pick winners or losers. The estimated total investment over a decade leading up to and including such events could reach $200 billion, suggesting that even small changes in tax policy can drive massive shifts in capital allocation across different sectors of the economy. This is not about getting rich quick, but about understanding how your government classifies every dollar you earn so you do not leave money on the table simply because you did not know the rules applied to a specific type of transaction. The difference between a 37% tax rate and a 20% capital gains rate isn't just math. It is the difference between keeping your winnings or letting the government keep half of them before you even spend them, which fundamentally changes how rational investors approach risk in their personal portfolios during high-stakes periods like major tournaments. By treating these markets as investment assets rather than gambling venues, we unlock a level of tax efficiency that has been available to institutional traders for decades, but is only now becoming accessible to everyday viewers through regulated digital platforms designed with the same rigor as traditional financial exchanges. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.